Good morning, everybody. Thank you for coming. Today we have Melissa Prado from Nova School of Business and Economics, and she's going to be telling us about capital commitment and investment decisions, the role of mutual fund charges. Melissa, you've got 75 minutes for the talk, and I'll just periodically interrupt you when questions come through the chat box. So thank you for presenting, and go ahead and begin.
Okay, thank you, Kevin, and thanks again to the organizers for having this wonderful seminar series. And thank you guys for showing up, and good morning to those of you who are in the US, and if you're like me on the other side of the Atlantic, good afternoon. So I'll be presenting a paper which is joint work with Juan Pedro Gomez, who is at EA Business School, and Rafael Zambrana, who is at Notre Dame, and they're supposed to also join in at when they have a chance to join in. They might have done so already. Let's get started. So basically, the question we ask in this paper is, why are not all mutual fund managers patient? There is empirical evidence that suggests, papers by Kremers and Parikh, Landmonat and Wormers, that managers who hold on to stocks for longer periods of time do better than managers with a shorter holding horizon. So this sort of is what started us to think as to why are not all managers patient or taking advantage of long-run investment strategies. And the angle that we explore in this paper is looking at the underlying supply of capital. Could it be that the fund investors themselves are impatient and thereby compromise managers' ability to take advantage of slow-moving arbitrage opportunities or have longer holding periods? So this is the angle that we're sort of exploring in this paper as a plausible explanation as to why not all portfolio managers are patient or investing according to long-term investment strategies, given that it seems to pay off. Now, the problem with trying to trying to look at this angle is that it's not easy to figure out the investment horizon of the underlying investors. So what we then did is we looked at load funds, and load funds have typically broadly 3 share classes. And in the choice that an investor makes among these share classes is an sort of ex ante commitment as to how long they intend to hold the fund shares. So here you see the different classifications. So there's 3 broad share classes that we typically categorize load funds with. So you have either a front-end loan, which would be the first share class, which means you pay a fee upon entry that's automatically deducted from your invested capital. You also have the back-end load as an alternative share class. It's often called a contingent deferred sales charge, which could also be waived if you're holding on to the fund for a longer period of time. And then you have the third share class, which typically has a negligible front end and back end load, but a more sizable annual fee. So, and in this choice of these share classes, it is effectively what we posit as the choice conveying information as to how long you intend to hold the shares. So if you're going to invest for the very short run, then you're probably going to opt for the level share class. Whereas if you're investing for a long period of time, it economically pays off to go through the share class A or B. And this is the information that we're going to be using as a proxy to measure the fund investors' investment horizon. Now, how we're going to...
Melissa, you've got a question from Sagata. And he asks, how does this relate to the literature in the hedge fund space on lockups, perhaps by George Aragon and others?
It's a very good question, and I have it also on the slide when we discuss sort of the contribution with respect to the literature. But to give you an answer, here we're not talking about a restriction. So here it's about efficient matching that is taking place. So here you're not locking in investors, but investors are ex ante signaling that they're most likely going to stay 4 or 5 years by means of investing through a front and a back end load. So that would be the difference with respect to the hedge fund literature. And it is also very important to look at open-ended funds, which obviously are a dominant source of of availability for retail investors to invest through, and trying to figure out how we can create that sort of efficient matching, and whether that matching conditions a portfolio manager's decision making. So we're using this as our measure for fund investor horizon. And basically what we do is for each fund and each quarter, we calculate the percentage of asset that come from front and back end loads. And this is what we will be calling the capital commitment. Now, by going through the front and back end load, that basically is signaling some information to the managers, or so that is what we hypothesize. Whereas if you're investing, if an investor comes with a sort of buys a level load share class or no load share class, there's no revelation of any information as to the investment horizon of the investor. So this is something that we obviously also have to test and validate whether what we're effectively capturing is in effect a capital commitment. So we hypothesize and we are going to test the choice of the share class, whether that effectively is a signal of the capital commitment, the engagement that investors have in the long run with the fund, and whether then this conditions the manager in his portfolio choices. So basically that's the setup of the paper, and the talk is first showing you that a validation of our capital commitment, and subsequently seeing how that influences the portfolio decision making of mutual fund managers. So to show you some anecdotal evidence of how this matching can go wrong, here I have a picture of Neil Watford, which used to be a very prominent UK portfolio manager. So he was the best portfolio manager for 25 years in a row for Invesco, and then started in 2015 his own asset management company. And curiously, he called the asset management company the Woodford Patient Capital Trust, the Woodford Patient Capital Trust. And in one of the funds that the asset management company offered, the flagship fund was an equity fund. And in this fund, this was a no load fund. So the portfolio manager, Neil himself, doesn't know exactly what the investment horizon is of the underlying investor. Nonetheless, was investing in very long-term investments and basically trying to capitalize on a high illiquidity premium. So it was investing mostly in highly illiquid stocks. Now, this obviously went well for a period of time, but then as redemption started to occur and three big investors left the fund, this is when in 2019, the first signs of trouble appeared, and eventually the fund actually was suspended and went bankrupt, as it did the asset management company. So now today, if you were to look up his name, he's sort of associated with being the failed portfolio manager, not anymore one of the best portfolio managers. But this is what sort of serves as an example as to what we are trying to look at, is sort of the undermining of the supply of capital, the fact that sort of the investors might have a very different investment horizon than the portfolio manager in his investment choices. And this can then lead to difficulties in executing their trading strategy, and be a plausible explanation as to why not all portfolio managers are pursuing illiquid or long-term arbitrage opportunities. So a roadmap of the paper in itself, and also the talk, as I mentioned before, is like there's two parts to the paper. First off, we look at validation of our capital commitment measure. Is it so that the investor choice among the fee structure indeed leads to is a capital commitment in itself? And we do that by looking at the correlation of our measure with fund flow volatility. So if we're effectively capturing capital commitment, then we would expect those funds with higher levels of capital commitment to have less fund flow volatility. Now, additional tests that we do, which is on a subsample period because of the data availability, is based on data that we get from Barber and Odeen, based on their infamous paper that has household level data from a US brokerage firm. And there, what we look at is households that invest through front loads or back end loads in mutual funds. Do they indeed trade more often in general their portfolio, or trade less in this case, as would be evidence of capital commitment? And do they are they more patient also with the funds that they hold and the underlying mutual fund holdings? So that is an additional test that we do with this unique data to corroborate that those that invest in front and back end load funds are indeed more patient and allow therefore managers to pursue different strategies. And that is effectively what we do in the second part of the paper, where we look at how does this then condition the decision-making of a portfolio manager. So what is it that these managers can then do differently when they know that their investors are more long-term oriented? Well, first off, it facilitates the liquidity management of the fund. So we're going to be looking at the ability of managers to predict flows and adjust their cash balance accordingly. And we see that that's going to be that's easier for funds that have higher levels of capital commitment. Then we're going to look at their portfolio choices. The first ones being how long they hold on to shares, seeing whether or not the portfolio duration increases when they have more capital commitment in the fund. And as we've seen from the other papers, portfolios with longer duration tend to do better. And we're going to see what's the role of the underlying capital in explaining that as well. And then we're going to be looking at the portfolio choices in terms of the investment strategies. Think about how they invest in, whether they invest more in illiquid stocks, for example. And then in the paper, we have also additional other variables that relate to more long-term arbitrage opportunities that might arise.
Melissa Bacus has a question. I'll let
Yes.
him ask it directly.
Yeah. Hi, Melissa. So
Hi.
I had a question that in addition to, so the example of the Woodford fund is quite interesting because I cite it in my paper where we look at mutual funds investment in private securities. And he was investing in some private firms, which basically, went south. And so I was wondering that in addition to the fact that, of course, there's a matching between the investor and the fund, there is this whole issue of strategic complementarities, which is that regardless of what your horizon is, once the fund has had bad performance, it can actually trigger investor runs, which actually would cause the fund, it will have impact on everything, including cash management, including portfolio choices of the fund managers and so on. So that's something which is going on in parallel to what you're talking about. So
yes, yeah, that's a good point, and we haven't sort of explored that in great detail. So in this example, it's an extreme example in which obviously this illiquidity goes into even towards non-listed securities, and sort of we haven't really thought about sort of this self-fulfilling sort of prophecy that might arise from this this mismatch. In our setting, because we're sort of focusing on equity funds, we're probably that is a bit less of a concern because the degree of illiquidity is not as extreme as what sort of the Woodford, but it could be something worth exploring. So yeah, we'll think about how to do that in more detail.
Thank you.
So to give you a sneak preview of the results, sort of what we'll show you is that funds with more capital commitments have lower fund volatility. So that's indeed suggestive of these underlying investors being more patient. This allows managers in turn to better predict flows and adjust their cash balance accordingly. And these managers tend to hold on to stocks for longer periods of time. So that's consistent with them being able to be more patient because of their underlying investors' patience. Then we know that those funds that have longer portfolio duration, so that hold on to stocks for a longer period of time, tend to do better. Now, what we'll also show you is the part of it that is explained by capital commitment is mostly responsible for that. So we're going to be decomposing that portfolio duration and seeing what part is due to the underlying supply of capital. And what we find is that economically and statistically, this is the most important explanation as to the outperformance of funds. So the residual net of the capital commitment does not predict outperformance at longer investment horizons. So somewhat in the intermediate, we'll see a bit, but economically the concentration is in the capital commitment, that the part of the part of the duration that is explained by capital commitment. So and the last thing that we'll show you is that this conditions the manager's investment decision, and in the examples that I'll show you is mostly related to holdings of illiquid securities, and in the paper we also have alternative slow-moving arbitrage investment strategies, and we see that managers with more capital commitment hold more of these investment strategies, so invest in more slow-moving arbitrage opportunities and highly illiquid stocks, capitalizing on this long-term liquidity premium. So how does this paper relate to the literature? So it relates to a lot of streams of literature. The first one, the obvious one, is to the literature related to the share classes. What we'll show is that the choice of the load shares in itself also conveys information to the managers and conditions their portfolio decision making. Then it stresses the importance of liquidity management and having an efficient match between the underlying investor's investment horizon and that of the portfolio manager. It also relates to the papers relating towards broker sold funds, because it provides an explanation as to why asset management companies still continue to offer these share classes in the sort of evidence that we have that they tend to underperform or have distorted incentives. The actual intermediaries, these brokers, can provide value in the choice within the share class, which then provides some signal to the managers as to the investment horizon of these underlying investors. And as I mentioned before, it also obviously relates to the hedge fund literature in the lockup that exists there, where we have explicit restrictions to avoid these situations from happening, where hedge funds invest in highly illiquid securities and therefore dissuade redemptions by means of having a lockup period. Now that is mostly a constraint, and here what we'll show is a situation in which an efficient matching takes place that we can observe by means of the selection of the underlying investors, and that allows then the portfolio manager to pursue strategies that are consistent with the investment horizon of its underlying investors. This also relates to papers that have looked at the mutual fund structure being open-ended versus closed, and how that then relates to sort of the portfolio decision making. Now here what we're looking at is within the open-ended mutual funds, which is obviously the dominant source of mutual funds, how you can also achieve sort of this matching efficiently by means of signaling the investment horizon of the underlying investment. And the proxy we're using for that is through the load shares. Lastly, it relates to the literature on short-termism, right? By showing that there is an explanation as to why not all portfolio managers are patient or investing in long sort of term investment strategies, because their underlying capital might be impatient and not allowing them to do so. So the data that we are using is the standard US domestic equity mutual funds over the sample period 1992 to 2017. we're using the classic, if you will, data set. So the CRISP mutual fund, the CRISP mutual fund database. For the holdings, we use Thomson. We supplemented with the trading horizon that we get directly from Kramers and Parikh. And we'll have some additional tests, robustness tests, in which we're controlling for the manager's incentives. And that data we gracefully got from Matang and Gomez. Then for the household level data that we're using as our way to validate that what we're effectively capturing is indeed sort of a long-term investment, from the actual underlying investors. We use for the subsample period that we can, the data from Barbara and Odin, and show that households that invest through front and back end load in mutual funds indeed are more patient. They trade less within the actual fund as well, and across their whole portfolio. Okay, so the rest of the data is the standard data from CRISP and Computstat. So let me show you a little bit of what our data looks like, and our measure of capital commitment to be precise. So the assets under management, the average that represents capital commitment over our sample period is around 22%, 23% rounded off, of which the bulk comes from front-end share classes, and minority comes from back-end share classes. As compared to those in the third share class, the level one, where you have a higher annual fee. So that would be the one that corresponds to more short-term oriented investor. That would be around 8% of assets under management. And for the no load, where we don't observe the signal, and as the other side, would be around 45% of the assets under management. So that brings me to the first test. And the first test centers around trying to validate our measure. So what we have as capital commitment is the sum of the assets under management that come through from load share classes with a front end and a back end load. Okay, so that is our measure of capital commitment. Now, if this is really a good proxy for the investor horizon and the patience of the underlying investor, then what we would expect is that it should be negatively related to fund volatility. So if capital commitment really captures an engagement of the underlying investor to hold on to the fund for a longer period of time, these funds with more capital commitment should be less volatile, should have less volatile flows. And that's effectively what we test here. So here we have a panel regression in which we're regressing fund flow volatility on capital commitment. In the second specification, we also control for institutional investor ownership. And then in the third specification, we decompose the capital commitment variable into the front end and the back end. Now, important here is that both of them matter. So both of them contribute to our capital commitment. And indeed, funds with more capital commitment have indeed much significantly lower fund flow volatility. Okay? All our variables are standardized. So what you see here, let me just get rid of the R over here, is a 1 standard deviation increase in capital commitment is associated with a reduction in fund flows of 0.17, which corresponds to the average flow volatility of around being a representative of 19% reduction. So even economically, there is a sizable effect on fund flow volatility. Now, in the first 3 columns, what we have, we introduced time and style fixed effects. And in this 4th through 6th column, we also add family fixed effects to absorb any sort of unobservables related to the fund family strategy in terms of the distribution channels or any other observables at the fund family level.
Melissa, Vikas has a question. He wants to know how institutional investor ownership is being measured.
So it's based on it's based on the flag in CRISP, I think, if I'm not mistaken, in terms of how much, and then we just aggregated to figure out how much of the ownership is attributed to institutions.
Okay, thank you.
Okay. So what we just saw is that investors in share classes with entry and exit loads tend to be more patient in that it is associated with lower fund flow volatility. And this is robust to whether we're looking at front and back end shares separately, whether we control for institutional ownership, so that, or as a measure, for example, of sophistication of the investor base, and also when we control for, which we have in the table in the paper that you have, no load funds. So this combines provides evidence that front and back end load investors are providing a capital commitment that is more long-term oriented. Now, as additional tests, what we do is we use the household data that we got from Barbara and Odine to look at the actual household level choices and whether we can see that those households that invest through front and back end loads are indeed more patient. So these are the two tables that validate as well. Here, what we do is we look at from that data set that we get from Barbara and Odine, household decision making basically, and see those households that invest in mutual funds, that invest through front end loads, back end loads, or the alternatives, level and no load. How patient are they? Okay, and in this case, we look at the portfolio turnover, and then within the mutual fund that they hold, the actual security level. That would be the second panel that you see over here. Now, what you see is those households that invest in mutual funds with a front load or back end load, indeed don't turn over their portfolio as much, versus those that have the level and the no load share class. Here I'm missing a negative sign, so I apologize for that. And you see that those that are investing through the level share class or no load are indeed less patient in that they're turning over their portfolio more frequently. Then when it comes to the actual holdings of the mutual funds themselves and the underlying securities, you see the same pattern arising in that those that go through the share classes that represent the capital commitment, those are the ones that seem to be less actively trading, if you will, as compared to those that do invest through mutual funds with no load or the level share class. Go back here. So this provides additional validation of the underlying investors having a longer term commitment with a fund when they're investing through these load share classes that have a front and a back end load. So that then brings us to the performance. And here what we do is we have the standard measures of performance and regress it on our variable capital commitment. And again, we're introducing style times time fixed effect to absorb any of the time and style specific variation that we wouldn't be able to capture. And what you see here, whether you measure it using a 1-factor model or a 4-factor model, is that there's a positive relation between capital commitment and fund performance. So funds with higher levels of capital commitment outperform funds with less capital commitment, and these are standardized numbers. So a 1 standard deviation increase in capital commitment translates into 24 basis points better performance when I'm measuring it using a 1-factor model on an annualized basis. Now, this is using gross returns. So you might think that this means that it just might accrue the benefits to the underlying fund themselves, that they're reaping those rents. But when we do it using net returns, we observed similarly a positive and significant relation between fund performance and capital commitment. Again, here we also include family fixed effects in the latter three panels to again try to absorb anything that is family specific. The additional task that we do is we also measure this in not the level of capital commitment, but using the change. So as capital commitment increases, how does that influence performance? And you again see a positive and statistical significant relation between the one standard deviation increase in capital performance leads to around 2.3% increase in fund performance on the basis of the one factor model. Okay, so whether we do capital commitment in levels or in changes, you observe that same positive significant relation. And with the change, the added advantage is that you're capturing sort of the change in the marginal investor. So as the marginal investor becomes a more long-term oriented investor, if you will, how does that influence performance? So what we see is funds with higher levels of capital commitment do better. And what we then want to know is what is it exactly that they do that allows them to outperform? And the first thing we look at is the trading duration of their portfolio. So we want to measure patient capital and whether this allows the portfolio manager to invest for longer periods of time, to have a longer investment horizon. Now for trading duration, there's various alternatives. So here you have the standard one from Kremers and Parik, which is the weighted average length of time in quarters that a fund has, that a fund holds a specific security over the last 5 years. And that is then weighted by the size of the position. And this is the variable that I will present and that we use, but we also have alternative measures that capture also that holding duration, whether it be the crisp turnover ratio or variables as introduced by Lan, Moneta, and Wormer, which are variations on that duration measure, like the simple holding measure, or one in which you're accounting for the inventory layers. These are all measures that corroborate the same thing. So we want to see if funds with more capital commitment indeed have a higher trading duration. So indeed are also more patient. So if your underlying investors have a long-term investment horizon, are you as a portfolio manager also having a long-term investment horizon? And we see here the regression of trading duration on capital commitment. And as you see, the coefficient is positive and statistically significant. A one standard deviation increase in capital commitment is associated with 0.10 higher trading duration, which is economically equivalent to around a 5% increase in the average holding period. Okay, so there seems to be an increase in the length of time in which mutual fund managers hold on to an average share that is longer in those funds that have capital commitment. Again, here we split it up in the second column by looking at the institutional investors and controlling for them, and by splitting it up in the third column among front and back end load. And here the front end load is the dominant, in which allows the portfolio manager to invest in longer periods of time, holding the stocks for longer periods of time. Now, again, our results are robust to including family fixed effects and time style fixed effects. Now, as I mentioned before, trading duration is one variable that you can look at to capture patient, if you will, capital. We've also done the same thing with the other variables as introduced by Lan and Moneta and Wormers. And here we see the exact sort of same positive and statistically significant relation between capital commitment and trading duration. So funds with more capital commitment tend to hold on to their securities for longer periods of time. Now we know that funds that have sort of a more patient investment strategy, if you will, or that hold on to stocks for longer periods of time, do better. That is what Kremers and Lang and Moneta and Wermers, Kremers, Parik, and the rest put forward. Okay, so that is not surprising. But what we want to explore is, to what extent is this due to the capital commitment, the underlying supply of capital that allows managers to do so? So to answer that question, what we do is we decompose the trading horizon into a part that is due to capital commitment and the part that is orthogonal to the capital commitment. So the first step is we regress the trading horizon, so the trading duration, if you will, on the proportion of capital commitment with the controls that we had in this previous specifications as well, and then calculate what is the predicted amount versus the orthogonal, sort of the residual amount, which would be the unexpected or unrelated part of the duration decision with respect to capital commitment. And then what we test is the relation between fund performance and the predicted one that is due to the underlying supply of capital, and the one that is orthogonal to the investor's investment horizon. And this is where we have that decomposition. So we already know that patient capital and managers with a more patient investment strategy do better. And now what we're looking at is that decomposition that takes that we just did, in looking at the part that is due to capital commitment and the part that is orthogonal to capital commitment. And what you see here is that economically and statistically, the part that is due to capital commitment is dominating in terms of explaining the fund performance. So this suggests that there is a role for the underlying supply of capital that will allow or makes it difficult for managers to pursue long-term strategies when they don't have the underlying commitment of the investors.
Melissa, there's a question from Manish Jha, and they say, I was wondering, since the observation is at the fund level, should fixed effects also be at the fund level rather than the fund family level?
So that's a good point. We tried to do also with fund fixed effect. The problem is that you don't have much variation in the load structure. So you'll see that load funds will always tend to be load funds, and there's not really a lot of variation that we can capitalize on there.
Sounds good, thank you.
So there is, in terms of trying to explain the relation between patient capital and performance, there is a role for the underlying supply of capital in allowing this relation to materialize. And in these regressions, these are just the following month, but we also have done regressions over sort of longer holding periods. And there you see that the residual component basically washes away after the first month. And that only that part that is due to the capital commitment is positively and significantly related to better performance. So funds with higher capital commitment exhibit higher alpha. But what is it exactly that these funds are doing differently? So now what we'll try to do is try to pinpoint the mechanism for that increased performance. Now, what can these funds do differently? Well, the two things we explore is, first off, maybe it's easier for them to manage the liquidity of their fund better because these investors have a long-term investment horizon. So we're going to be looking at the liquidity management capabilities of these funds with capital commitment versus funds with less capital commitment. And then secondly, we're going to be looking at the actual investment choices. So not just the holding period, but maybe they also invest differently in terms of trying to capitalize on slow moving arbitrage opportunities. So think of illiquid stocks, for example. are they likelier to invest in more illiquid stocks compared to funds with less capital commitment?
Melissa, I think there's a clarification question on the previous result.
Okay.
So Jay Wong says the negative relationship between alphas and institutional shares seems to be contradicting the previous findings, doesn't it?
Let's see. Or performance. Here it's not statistically significant. Economically, there is still a negative. So is that what you meant, or you mean just in general of what we observe about institutional investors and fund performance?
Ji Wong, go ahead and clarify if you'd like.
Yeah, I mean, just the last table that you just
Yeah.
showed us. Yeah, there are institutional investors. There's negative signs on it.
Mhm.
But I thought that usually these institutional investors, their share classes, it has positive relations to future or fund performance.
Yes, it's true that in the literature, indeed, there is a sort of, for example, a paper by Richard Evans when they're looking at retail versus institutional.
Yeah, that's right.
I haven't, so I'll write this down. I haven't really looked into that. We haven't looked into that too much. We thought it was important to control for, but we can start thinking about what explains this negative and statistically significant relation with.
Or perhaps when you drop this patient capital and duration, then maybe institutional investors could have a positive impact from performance. I don't know. I'm just guessing.
So in the previous one that we had over here, there we also seem to observe a negative sign, but it's not statistically significant, so it's not really distinguishable from zero. But we don't see that positive one, right? That we're sort of that you're hinting at. So yeah, good catch. I don't know exactly what is going on. We can or a little bit more as to why sort of institutional investors are negative here.
Okay. Yep. Thanks.
Thanks. Okay. So now that I've shown you the results related to performance in which funds with higher capital commitment exhibit higher alpha, then the question becomes, what is it that these funds do differently? What is it that allows them to deliver that outperformance? And there's two things that we're going to be looking at, sort of the liquidity management. So are they better able to manage the liquidity of the fund? And here we have a test in which we're measuring how the mutual fund manager uses his cash balance in response to the flow predictability. And that will allow us to see sort of the liquidity management ability, if you will, of the manager. So the variable we're going to be using is the R² of a regression of flow on cash. And that R² is a rolling window sort of from the past 36 months. So that basically tells you, based on the information that the manager has from the last 36 months, how do they time their cash balance so as to accommodate the flow management and the liquidity management in general. And what we'll try to test is see those that have more capital commitment, do they have a better ability of doing so? So would have a higher R². Then the second thing we're looking at is the investment strategies. So I don't have all of these, the investment strategies in the presentation. The paper has a lot more, in which we're exploring basically whether managers are taking advantage of slow moving arbitrage opportunities, next to just being more patient in that they're holding stocks for longer periods of time. Do they invest in more illiquid stocks that are on fire sales, for example, that take a long time to correct? This would be a way in which they can capitalize on that arbitrage opportunity, but that's only available to those managers who can afford to invest in these long-term strategies. So that's what we do over here, trying to zoom into the mechanism that leads towards that outperformance. The first one is liquidity management. Now, as I mentioned before, we're going to measure the ability of managers to time their cash balance well with respect to their flow volatility of the fund. And that we measure by having a rolling window regression, and the R² of that regression of flow on cash. It's basically telling us how good the manager is in predicting flows and adjusting its cash balance. And what we then do is take that R² and regress it on our measure of capital commitment. And what we would expect that if capital commitment allows managers to have a better predictability of their flows, then we would expect a positive and significant relation with our measure of liquidity management ability. And that is effectively what you see in this table. There's a positive and significant relation between capital commitment and this ability to manage flows with your cash balance. Economically, it is a 1 standard deviation increase in capital commitment is associated with a 0.4% standard deviation increase in predictability and the ability to adjust your cash balance to the flows. And this represents an increase of around 7% with respect to the average prediction ability. So economically, it's also quite sizable. Now, again, here we split it up between front and back end investors, and mostly those investors coming through front end loads allow managers to better time and manage liquidity as captured by our measure of predictability of the flows and the ability of managers to adjust to that. And results are robust when we're controlling for institutional investors, when we're controlling for family fixed effects, and obviously all baseline specifications have time and style fixed effects. So this indeed suggests that part of the outperformance is ability to better time the cash balance with respect to the flow volatility of the fund. The fact that the investors are more patient makes the liquidity management job for the portfolio manager easier, and that obviously allows him or her to deliver better performance. Secondly, we look at their portfolio choices. Here, what we look at is the illiquidity of the underlying holdings. So here we have the daily, the quarterly average of the daily Amihud illiquidity of the overall portfolio of a fund. And we regress that on capital commitment. And what we indeed see is those funds that have more capital commitment invest in relatively less liquid securities. In terms of the magnitude of that effect, a 1 standard deviation increase in capital commitment is associated with a 1.4 standard deviation increase in portfolio illiquidity, which represents around 44% of the average illiquidity of the portfolio. So it is a sizable effect. As funds have more capital commitment, the portfolio manager seems to be more likely and willing to invest in illiquid securities as they're less likely to face redemptions, which would then make it very costly to do so and undermine the manager's portfolio, the management's investment strategy. Again, we do the decomposition with respect to fund and back end investors and controlling for institutional investors and the family fixed effects. We're going backwards. So what I've just shown you is that there's those funds with more capital commitment have better performance. Mechanism through which that performance materializes is better liquidity management and also their investment choices. In the paper, we have alternatives for investment strategies. We also have other strategies that are often associated with longer investment horizons, like the amount that they invest in fire sales stocks, other variables that might sort of proxy for a long-term investment horizons that pay off in the long run, like R&D, the number of patents, are all variables that we have also used in the past as alternatives and are positively related to our measure of capital commitment. So it is indeed suggestive that funds that have more capital commitment are likelier to invest in assets, in stocks in this case, that take a long time for the arbitrage opportunity, if you will, to materialize. Then what we also did was a test that I don't have in the slides, but I'll elaborate a little bit more about it, based on sort of the factor loadings on which these funds are loading onto. And specifically, there's a paper by Daniel Hirschleifer and Son, who have a short-term and a long-term mispricing factor. And interestingly enough, those funds that have a higher level of capital commitment positively load on this long-term mispricing factor. So that's again consistent with the investment strategy of the fund, with capital commitment being different from those that don't have the luxury of having patient investors.
Melissa, you've got a couple questions here. The first is from Meng Wang, and he says, is it helpful to decompose performance into a horizon-based performance measure? I was wondering if the overall improvement in alpha with patient capital is driven by short horizon investment or long horizon investment. If funds specialize in the short horizon, would they switch to long horizon to match the investor's horizon of more patient capital?
Okay. So I think that, sorry, I didn't catch the full question, but I think the question is related to sort of matching on both sides. You know, that the short-term investors would have a short-term investment strategy, and long-term it relates to long-term investment strategy. Is that what?
I think my interpretation is he's basically saying you've got this relation between your measure and then the performance. Can you decompose the performance into their performance, the fund's performance on short-term investments versus long-term investments? I think that's my interpretation.
Yes. So in the paper, we have looked at short-term versus long-term outperformance. And in particular, when we're doing the decomposition of the duration variable, so the part that comes from the capital commitment and the part that is orthogonal to the underlying supply of capital, and there we did see sort of but we haven't. There we did see that those with capital commitment, the predicted part is across all of these long-term investment horizons and performance measures, indeed positively related. We didn't look at the decomposition without that, which is something we could do.
Okay. And Vikas has a question, and he'll ask it directly.
Sure.
Yeah, hi, Melissa. I was thinking that this point about the manager's performance evaluation period, you control for it in your performance regressions, but what would maybe also interesting is to see if there is any correlation between the performance evaluation period and the capital commitment itself. So in other words, like if your investors are long-term oriented and managers are using long-term strategies as you're showing, then we should expect that the performance evaluation period should also align with that, and the contracting should be done such that they are given long-term, you know, their evaluation is also on a long-term basis.
Yeah. So you're suggesting that the asset management company is aware of this and sort of associates makes the incentive such that this matching can be done in the best way.
Right.
We haven't, we controlled for it, and I'll show you that in the following sort of table, but we haven't seen it as, we haven't looked at it as an explanation as to why some managers have a longer evaluation period and some have a shorter evaluation period. So we can look into that.
Yeah, because if the company doesn't give them, suppose if the manager wants to have long-term strategy because the investors want it, and then the incentives are not aligned with it, then it shouldn't work. So maybe there could be some misalignment there as well. And but maybe on average it should be aligned, but there could be some cases of misalignment, in which case you could see whether your results are stronger when there is better alignment of incentives with,
Okay.
so that could also give you some more bite. The
Yeah,
other thing that I noticed, which was interesting, is throughout your all the results you've shown, it seems like the front end seems to have a much bigger effect than the back end, which I find interesting because if you think about front end, it's like a sunk cost fallacy, right? So if I've already paid the front end, there is now, I mean, that shouldn't make investors stay longer as much as the back end load, where clearly you have bigger benefit of staying longer. So
yeah, that's true. It is. In general, just the frequency and the magnitudes, front end is much more dominant than back. So funds, very few investors are using the back end load structure. But indeed, it's quite interesting that the front end, it is indeed a sunk cost, and you could exit at any moment, right? And in the back end, typically is also the sales charge is waived after a period of time. So that could be partially explaining a little bit what is going on. And we don't have sort of done anything in terms of, because that obviously is quite difficult to get your hands on the data as to what are the thresholds, when is the time of waiving, and how that varies across the different funds.
yeah, I mean, you can you can still simply mention this point because I think it's still interesting to see this sort of dichotomy between the front end and back end load. So that was just a comment.
Okay, good. Thanks. So did I answer all the questions, Kevin, or?
Yes, you're good to go.
Okay. Okay. So let me first take you to the results that Vikas was already hinting also at. In terms of what could be going on as an alternative explanation, is that our capital commitment is just capturing sort of the incentives of the managers, and they might just have a longer performance evaluation period. So we borrowed the data from Matang and Gomez and controlled for that in our specification to basically show you that that's not the only thing that is going on. We haven't looked at the mismatch that might occur between the explicit incentives and capital commitment on performance. So that's something we could do here. The test is as follows. We regress fund performance on our measure of capital commitment, and then control for the manager's evaluation period, right? So to make sure that that's not driving our results. And as you see, when we control for the manager evaluation period, it's positive and statistically significant to performance, but it doesn't take away from economically nor statistically from our capital commitment. That still remains positively and statistically significant to performance. So the underlying managers' incentives are not explaining our results. So overall, what we've seen is that managers with more capital commitment outperform managers that don't have that explicit sort of engagement of the underlying investors. And that's due to their ability to invest more long-term, hold on to liquid securities, and more efficiently manage liquidity. Now, there is in the asset management industry a lot of pressure on reducing these loads, and these load funds are to some extent disappearing over time. So the question then arises, if we're losing this information signal, what could the managers then do to obtain that information and still allow them to invest in long-term strategies without getting into trouble like Neil Woodford did? So what we then did as an alternative test is see that for those funds that are launching a no-load fund, where you would not have that information signal anymore, we looked at their prospectus and counted the frequency in which they mention the word long-term. Okay, so as an alternative signal in which they're trying to communicate to investors that this fund is a long-term fund, so as to create that that matching again without the load structure in place, akin to a little bit what Neil Woodford did with his patient capital trust, right? So there's already in the name a clear emphasis on a long-term strategy. And what we find and you'll see the results in the paper, is indeed funds that launch a no load, that used to have a load structure in place, are likelier to mention now much more frequently the word long-term. So as an alternative way of trying to create that matching. Now in the paper, sort of we don't have a stance on whether funds should have a load structure or not, but mostly we're using it as a proxy for the investment horizon, and put forward that matching helps managers achieve better performance. And as that might disappear, because there's obviously pressure from ETFs, and these explicit funds are not really sort of nicely perceived by investors, then what we'll try to do with this type of test is to explore a little bit more what could be alternative mechanisms as to where the managers obtain that matching. So let me conclude. So the paper puts forward an explanation as to why not all portfolio managers, active portfolio managers, are pursuing these long-term investment strategies, right? Why are they all not patient? And we do so by looking at the underlying role of the supply of capital. So using a proxy for the investment horizon of the underlying investor, and we measure that as being our measure of capital commitment, the amount of capital invested through front and back end load. We explore the role of the supply of capital in undermining managers' ability to invest patiently, right? So if your underlying investors have a short investment horizon, then for the manager it becomes difficult and very costly to engage in long-term strategies and capitalize, for example, on an illiquidity premium. Right? It becomes quite risky, and you could end up in a Woodford situation. So what we've shown is that the lack of capital commitment complicates liquidity management. So funds with more capital commitment are able to accommodate their cash balance better with respect to their flow volatility, and therefore manage the overall liquidity of the fund much better and much more efficiently. We've also shown you that lack of capital commitment is associated with less short-term investment, and that it decreases the fund's holdings of illiquid securities. Also in sort of the paper, you see that we have other proxies for slow-moving arbitrage sort of strategies. And in general, funds with less capital commitment engage buy less of stocks with long-term sort of investment opportunities. It undermines managers' ability, therefore, to deliver this long-term alpha if there is no capital commitment given by the underlying investment. So overall, this suggests that there is a shadow cost to this pressure as to remove the explicit load fee share class that could lead to complicating managers and creating a situation in which this matching is not efficient. So overall, that's it on my end.
All right. Thank you, Melissa. Are there any other questions?
So I had one question, Lisa, which I've always thought about funds with multiple share classes. So let me ask you that. So if a fund has both short-term and long-term investors, in reality, they don't have purely short-term or purely long-term investors. They have a mix of the two. Mm-hmm. And so there could be a tension between the expectations of these investors, and how does that play out in your analysis is what I was wondering, because you're kind of putting them into, just based on the total amount allocated to load versus no load, but mm-hmm. It's more complex than that. And if you actually take into account the fact that, if there are both short-term and long-term investors, they might have different expectations, which can actually make the task of the fund manager more complicated.
Yes, it's true. So what we do with the capital commitment, which is that the sum of the assets that's coming from front and back end load, is particularly in the test where we're looking at the change there you could sort of think as the marginal investor becomes more long-term oriented, you see a stronger effect on the performance. And that's exactly sort of the dynamics that you're hinting at. So the manager should be catering to the dominant marginal investor in his investment strategy. When you look at the change in capital commitment, we're trying to pinpoint that a little bit closer. But it's true that the magnitude in itself, we could do maybe some tests in which we have very high levels of capital commitment versus sort of almost none, or split is sort of in different ranks of that, to sort of see how that tension can arise between short-term and long-term investors. The problem is it's not easy to pinpoint short-term, right? So we can pinpoint no information, and that would be no load and the level. The level could also still be long-term investors that are opting to just pay an annual fee. So it's less clear as to what would be short-term investors versus long-term investors. And that would be a sort of, if we could pinpoint that, that would be very interesting to sort of do that dynamic and see when one dominates versus the other, or when it's very mixed, how does a mutual fund manager then tackle? But the problem now is that it's relatively easier to pinpoint long-term, but it's not so easy to pinpoint. Well, yeah, it's not clear whether the other would automatically become short-term investors.
Yeah, and if there are such short-term investors, I wonder, when there is a domination of the long-term investors, then what do? They just get out of the fund. So you then have to trade off this thing, right? Like, oh, then those guys think, well, you're catering to the long-term guys, so maybe we should get to another fund. So,
and it's also, so we were thinking with this paper about that mismatch and making that a little bit more explicit, but it's not short-term tends to underperform, right? So it's not clear why any manager would want to pursue a sort of short-term investment horizon at all. So it becomes kind of difficult. So that's why we start off motivating the paper saying, so if we know long-term strategies are the best, why don't we all pursue long-term strategies? And maybe all managers are doing that, but then get the impatient investors, and that undermines their capability of delivering that long-term strategy.
interesting. Thank you.
Anybody else? Any other questions?